This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and as always, we're pleased to welcome on another great guest. Today, we have Doug Smith with Castle Rock Capital, and we're going to be discussing lending, and specifically single-family lending. We've covered a lot of commercial, multifamily syndications, commercial debt, and while, in our conversations leading up to this, Doug, we certainly talked that you have experience in that. We really haven't kind of touched too much on the single-family debt side of things. We've talked about the benefits of buying single family homes, flipping them, strategies. But, one thing that kind of comes to mind when you think about real estate is its price. And, very few people are afforded the luxury to be able to do things cash. And really, there's benefits to not buying everything cash when you're doing real estate to begin with. One, you can buy more stuff if you're not using all your capital for one deal. Two, there is, different reasons why you might want to use debt. But we maybe don't get into that specifics today. But again, very pleased to have you on with us today. So Doug, maybe give us a little bit about yourself. We were just chatting how long you've been doing this. I won't give away the secret of it, exactly how many years that is, unless you want to chime in on it. But, needless to say, you have a large amount of experience. And we're really curious to dig into that. So tell us how you kind of got started doing what you're doing. What's your background look like?
Well, I'll fess up. My degree was actually accounting. And somewhere between my junior and senior year of college, I did an internship with General Electric in accounting. And I think maybe on day 3, I realized I did not want to be an accountant. But I was so far into it that, hey, I'm going into my senior year. What am I going to do? So I finished the degree and actually went into banking and lending. And that was 32 years ago. That was a long time. So yes, I have some gray in here. It's funny because I grew this beard out. My dad had passed of cancer a few years ago. And if you've ever heard of the No Shave November, a buddy of mine had a brother that was ill with it. And he brought it up to me. And I thought, my dad had just passed. I'm going to grow the beard. Came in gray. So I used to look more like you. Now, unless I grab a bottle of Just for Men, I have an issue. So,
hey, you wear it well. I'm starting to get a little bit of the salt and pepper here. So, my dad rags on me for it, but I'm like, I got the genes from you, man. It's either it's gonna go way up top and it's gonna go gray down below. So I don't know what you want me to say. So that's all you.
Well, yeah. As far as background is concerned, my apologies. I went off on a tangent there. I actually done it 32 years. Started out in finance and banking. Mortgage. I was moved to Florida in 1996 by Bank One to run this area for Bank One's mortgage division. Then went in, of course, to with First Union Wachovia for almost a decade, and was with their private client division. Ended up doing commercial banking with community banks for a long time before we started this company right around the last crash. Originally, we started to buy the bad loans out of banks and do commercial lending. But we started easing back into what I started in, which was residential. So that's the topic we talk about today. We broker them, underwrite them. We will work sometimes with private lenders that have capital but have no idea what they're doing, can't pull credit, don't know how to analyze a deal, and we'll do things like that. So we've done that 32 years. So it's not my first rodeo.
No, that's awesome. It's good to hear that you have a good amount of experience, because a lot of stuff that is born in today's market, especially when it comes to regulatory things and things to look at, a lot of the stuff that people are kind of up against, and, obviously it differs if you're talking about owner occupied properties versus, kind of portfolio properties. But a lot of, the legislation that people are concerned with is, born from the 07-08 crash, things like Dodd-Frank and different types of lending laws. So, let's kind of use that as our base to kind of, talk about, what people need to look at, because that's, obviously one, the market we're in, and two, the regulatory market we're in is definitely seeded kind of from there. Certainly there's stuff prior to that, things like usury and stuff that have been around for ages. But again, looking at that. So when it comes to, in general, let's say I was to walk up to you off the street and say, Doug, you know what? I've been flipping houses. I'm tired of dealing with tenants and termites and toilets and all this kind of stuff. I want to be the money guy. I want to start lending people money. What would be something, the first thing that you would, tell me besides, hey, it's good that you're talking to me and not just going out and writing alone without talking to someone with expertise. Obviously, talking to people with expertise is kind of bench one, but, what are some of kind of the first things that you would guide someone saying, hey, great, one, congratulations on being successful. Two, now let's try to help you out with being successful.
Well, I think there's several factors that come into play when you're new at it. And honestly, when I was a baby lender straight out of college, and even though I was working for an institution, I still had trouble saying one very important word, and that was no. I grew up on a farm. We always helped our neighbors out. And somebody asked for a rake, you gave them a rake, to borrow. And particularly with family members, if it's out there that you're lending money now, it's like you won the lottery. All of a sudden, knock, knock, knock on your door. Hey, I'd like to do this project. So saying no is very important, and knowing how to do it is important. That's one of the reasons that people will come to us to underwrite, is because I'm the bad guy at that point. It makes Thanksgiving a lot less awkward. But the regulation is a big deal. Documenting is a big deal. Understanding that just because the other person's a good person to you doesn't mean that that's a good loan. I'm going to give you an example. I was working for a community bank in the Tampa Bay area a long time ago, and as a commercial lender, and the board members would bring loans to me, commercial deals. So one of the board members, great guy, older gentleman, brought a loan to me and said, "Hey, I've got this friend who wants to start this business, and I want us to give him money." So I analyzed the deal, looked at it, and there was no way that I was making that loan. I was not going to sign off on it, and I declined it. Well, of course, this is a board member, and that made the board member very angry at me. He took it to the president of the bank and the chief credit officer. They backed me up. He got even more angry. He reached into his pocket, gave the guy over $1 million, and guess what? He lost it all. So there's a way to go about underwriting. For instance, pulling credit. Past predicts future. A leopard doesn't change their spots, as the saying goes. So if you take a look at a credit report, you can see patterns. You might see that somebody's doing well and then has falls off their bicycle and breaks their arm and has a little dip and comes back. But you also see those patterns that look like this: up, down, up, down, up, down. And past does predict future. Most private lenders don't go out and do things like that. They don't pull credit. They don't look at the ability to pay. In other words, capacity. The 3 C's of credit. Character, which is credit. Capacity, which is the ability to repay. And then, of course, collateral, which is how are you securing this deal. But there was a guy named John Sondrecker when I first started my career that said something that stuck with me all those years ago. And he said that the 3 most important things in lending are ability, ability, and ability. In other words, capacity. Does this person have the ability to pay the loan back? What's the exit strategy? So I think there's several pitfalls that people fall into when they try to lend money. And they read a couple of books, decide they're going to do it on their own, and then all of a sudden they can't figure out why they didn't get paid back.
No, that's a great way to put that. So to the point of, again, you said the 3 things are looking at the ability of them to repay as kind of the most important factor. Now, it's easy, or I shouldn't say, again, lending is definitely an art. I think a lot of this stuff is a lot more, art than just, hard functionality of looking at numbers. But especially from kind of the viewpoint that the people listening to this podcast are, because it's not the BlackRocks and the JP Morgans listening here, although love the exposure. It's people that are saying, hey, I would like to go out and lend someone some money. So while pulling a credit report, is well and good, how much, again, if it's more the individual basis, let's say I was, I flipped a couple of houses. I come to you, said, Doug, you know what? I got another one down the road. I need some money on it. Obviously, what kind of things are you looking for in credit? Is it just a long credit history, the repayment of it, or do different deals make you weigh like different factors of those 3 C's that you mentioned a little bit differently?
We're talking about for a flip?
Yeah, sure. Let's go with the flip.
Okay. Number 1, do they have any experience whatsoever doing it? Who's on their team? Have they hired a general contractor to be able to do this? We ask for a scope of work up front. So I have a spreadsheet that I provide each one of the borrowers that's called a scope of work, which says, go in and tell me what you're doing for flooring. What are you doing for cabinets? Have you thought this out? I need to have a good idea. I won't say a good idea. I need to have a quote from a qualified general contractor of what you're going to be doing to fix this place up. And does it make sense? Do you have something set aside called, we call it a contingency reserve, meaning if you ever watch HGTV, and by the way, most of it's fake, you know that. So they make their problems. Oh no, we have a problem. Uh, but problems do pop up. And so we usually build in 5 to 10%, depending upon the size of the rehab and the experience of the operator, into the deal, saying, "Gee, it's going to cost you more than you think. There's going to be a surprise."
Yeah.
So I don't know if that answers your question, but as far as the flip is concerned, we're looking at specifics on the deal, but going back to credit and I would say character, so to speak, on that. It's not as much character, but it's experience. You can have great people going in and trying to flip a house, but if I tell you what, first time I got behind the wheel of the car when I was a kid, I didn't do very well. I was stopping and going, but over the years, you get a lot better and smoother with it. It's the same with lending. Is keep in mind, I've worked with some of the largest banks in the world and done tens of thousands of transactions. So it's a lot of the things that I see when I do lending, I take as second nature. But this is your first time driving a car, you're probably going to start, stop a little bit, and maybe even go off into the ditch a couple of times.
Oh, for sure. Now, it's kind of, looking at betting on, are you betting on the jockey or the horse in that scenario of looking at the deal from two different places. So, that's one way to look at the flip. Now, obviously,
by the way, betting on the jockey or the horse, I didn't mean to interrupt. Betting on the jockey or the horse, yes.
Yeah.
we look at them independently. So
yeah.
typically we'll look at the jockey first and say, "Gee, jockey, this looks great. Go out and find a horse that looks like this."
Yeah, and then they show up on a mule, and you're like, even the best jockey in the world's not going to win the Derby riding a mule. So,
exactly.
Yeah. So from that perspective, there's definitely a lot of things to look at with flips. And would you say that, I mean, obviously it's all going to depend on kind of, setting up the deal correctly and doing your due diligence. But would you say to people, lending on someone on a flip versus someone on a rehab versus someone on just a straight rental, would you say that one of them carries inherently more risk, or maybe it's just harder to do? Like, would you scale them on saying, hey, if you want to be a private lender, find someone that wants to buy, a rental for a long-term hold, so you have kind of long-term cash flow? How would you kind of rank, let's say flip, rehab for rental, and just straight rental? How would you kind of rank those when people are going out and looking at deals, say, hey, you know what, this is a good one to get my feet wet with?
Okay, well, you're going to go backwards in that order.
Yeah.
If you're just buying a single family, I'm going to give you a good example of, we had a famous person that we just did a loan for that is trying to build a rental portfolio, getting into real estate, trying to hedge inflation. An important point, I'm going to go on a tangent, is as inflation goes up, historically, you can compare, inflation goes up, housing goes up. So it's a great hedge. But we just had a famous person that was their first time doing it. And I don't care how much money they had in the bank. They started out with a single family home that was, a family could move into it tomorrow. So there really wasn't anything wrong with it. They had it inspected. That's the least risk right there. And then, of course, a rental that may need, as my grandma said, a lick and a promise, maybe a little bit of paint here, some carpet, whatever, very, very benign cosmetic things. Then a more, now my wife is actually, her degree's design. So she's actually, she builds houses. So when she goes in and does a flip, and she's done tons of them, my gosh, she'll spend more than $100,000 on a flip, and how, ceiling falling in down to the studs, the whole thing, she'll go in and do it. So that's another level of risk. But the biggest risk comes into play when you have ground up construction. So if you're buying say a dilapidated property that you're going to have to tear down and build up from ground up, that's a whole different animal. So I would say that just buying a single family home that you can move a family into tomorrow, then the one with a little light rehab, heavy rehab, and then of course ground up construction. That's the level of risk.
Sure.
We will not do a deal for someone that's doing the top two, a heavy rehab or ground up construction, if they have zero experience. You kind of have to build up a little bit.
Oh, absolutely. And I think that, while it may be, common knowledge to most people, Yeah, it's definitely a good thing to reiterate is that, you and I've talked about this a lot when it comes to, commercial multifamily investing in the equity side of things as a limited partner and real estate syndications is that, while the deal can look great on paper, you have to know that the captain of that ship knows how to steer the ship.
Right.
If they've only, sailed little, schooners around the bay and now you give them, 100-foot sport fisher, you'd like to know that they can, one, take it out and two, dock it without crashing it. So, kind of looking at that, I think that's a good thing. Although it sounds simple, the simple things are the stuff that, again, you can do simply that will help you down the road. If you can do the simple things well, then the more complicated things aren't going to matter as much because you have a good solid foundation. Now, let's look at, like you said, kind of it was the inverse order of what I had mentioned, but just to kind of reorder that for people, the easiest, or I should say the way to ease yourself into it would be single family long-term rental, rehab for maybe a rental play, then your rehab and flip, and then new construction or tear down and then build up construction. What are the kind of differences as far as, it's going to be market specific to what you can actually charge, what your interest and what your rate of return is going to be for each of those. But what is kind of like maybe a general jump, if let's say, single family stuff, long-term rental, if you're going to do that for a private loan, let's just say, if it starts at 8, what does it go up to for the rest of them? If it starts at 10, what does it kind of bracket out for people when they can look at what might be reasonable to charge for this?
Well, to answer your question, I think it's important to understand why do interest rates, why are they set? Are they arbitrary? No, they're not. They're set for a reason, and let's talk about that. You hear about the Federal Reserve raising interest rates all the time. There's a good book, and I can't think of who wrote it. It's called Getting to Yes. It's about negotiating. And in that, they talk about a best alternative to negotiated agreement, a BATNA, meaning what's my best alternative? If I can't get this, what's my alternative? So let's think about it from the perspective of a very conservative investor. I don't want to lose any of my money, so I'm going to put my money into, say, a 10-year Treasury bill, something very safe. Well, as of this morning, that was trading between 3.7 and 3.8% yield. So I see all the time, hey, does somebody have a loan that they could give me for 3%? No, because why would somebody give you a loan for 3% and take that risk on you losing it when I could just take that money and get 3.7, 3.8 to Treasury?
Mhm.
So there's a hierarchy, and you have a risk premium that's built in. For instance, the average 30-year fixed as of this morning was about 6.9. That's for an owner occupied. For you to go buy a house today, it's risen to about 6.9. And actually, a week or two ago, it was well over 7. So it's kind of backed off a little bit. So beyond that, once you get into your rentals, you're looking at around 8, 8.25. Because you've got a risk premium above. It's more risky. Somebody's going to pay for their home before they're going to pay for their rental.
Yeah.
You're going to stay in your house. So there's about a 1 to 1.5% risk premium that's built in above what the 30-year fixed rates are. So, let's round it and say 7% right now for a 30-year fixed. It's a wee bit below that, but let's just say 7 for math's sake. So you add a point and a half to that, you're probably talking 8 to 8.5 for that. Now, if you're going into a flip, those are 11 to 12% all day long. But the most important thing to realize on that is not so much the interest rate as the fee structure that comes along with it, because you're only holding that for, let's say you hold it for 6 months. I grab it, I throw some paint on it, I do a little renovation, I put it back on the market, and I sell it within 6 months. The interest rate is not as important as the fees that are charged up front points.
Gotcha. So, and I guess that also kind of brings into, play again, looking at, and again, owner occupied being what it is. I don't know if we necessarily need to cover it too much because most people here are mainly
Right.
going to be looking at the investor side of things, which are not going to be owner occupied properties. So when it comes to that, obviously the fee structure, the cost basis for doing the loan and anything else is probably going to be the lowest for long-term cash flow properties. But like you mentioned, as far as a lender goes, you're not doing this out of the, the goodness of your own heart. I mean, maybe you want to help people, but at the end of the day, you still got to put food on the table. You have to make a profit. So if you're lending someone money out, yeah, you could lend it to them at 10%. But if they turn right back around in 3 months and you only got 3 interest payments, I guarantee you lost money on that, just by your time and effort to do it. And the fact that your capital was tied up. So is there kind of a difference when structuring these from going from, again, let's just call it those three. So the single family, long-term rental, the rehab to the flip. What are some things that are kind of baked into those to help people to make some more money that are kind of commonplace or maybe people don't even realize? Let's kind of go through like, how you make your money on each one of those, as a comparative analysis.
Well, there's going to be a difference. You mentioned owner occupied real estate, and for any of your investors that you're working with at Advanta that decide that they want to get into homes, I would forget about it because there's so much regulation that goes around that. We do that type of lending, but it's a totally different section of what we do. The Fannie, the Freddie, the FHA, the VA, the USDA, that's over here. The real estate investor stuff is a totally different animal. We'll want to lend to an LLC as opposed to an individual. We don't want that to look consumer at all because we want to keep the CFPB and Dodd-Frank, as you talked about, out of it and all that regulation. So if you're focused heavily on, I'm going to lend on single family owner occupied properties, unless you're a pro, I'd completely forget about it. The regulation is just too onerous for you.
Yeah. And if you did, I would, at least me professionally, I highly recommend you go to a licensed mortgage loan originator. Let someone else do all of that for you. Someone like Doug, and back when I was more involved in transactions and managing client capital, I would tell people that all the time, like, well, what about Dodd-Frank? I'm like, well, it's about like 950 pages. So why don't you pay for the expertise of someone that understands how to stay compliant with it before you just fire off a loan that's going to get you and your IRA, for that matter, in a whole heap of trouble. So,
right. Well, and licensing in different states.
Yeah.
For instance, I'll bring up. I know you guys have an office, I believe, in Georgia.
Mhm.
So you may have a lot of people on here from the state of Georgia. I was speaking at a conference several years ago, and you mentioned BlackRock. They were actually on stage with me. It was a panel discussion with four fund managers at that point. We were holding a lot of non-performing loans, and a gentleman stood up and raised his hand. He was from the Atlanta area, and he said, "Gee, I'm having trouble finding property to flip. Can I buy these non-performing loans?" And I said, "Well, the Department of Banking and Finance in Georgia sees things quite differently than other states. So you might need a lending license for the amount of volume that you want to do just to buy the notes. So you got to be really careful that you're not crossing into areas that are going to get you in trouble, not only with the feds and Dodd-Frank, but also your state regulators. Georgia, I'm in Florida, based in Florida. Georgia is very different than Florida.
Mm-hmm.
Florida, for instance, is what they call a lien theory state, meaning that when you sign your you buy a house or a property, you sign a mortgage, which is a lien against the property. In Georgia, it's a deed of trust. It's a deed theory state, meaning that that foreclosure is not judicial. So it's more the rocket docket. It's a lot faster than what it would be in Florida.
Yeah.
So the laws are going to be different in each state. And you've got to really understand those. And so you got to be really careful when you're private lending that you understand what you're doing.
Yeah, and the first kind of steps to get away from a lot of those regulations is to, if you're doing these to individuals, make sure they're not living in the property. It'll make your life significantly easier. Not that it is the Wild West and you can just do whatever you want. We'll get into a few of those things. I have a few questions I want to point at you. But again, let's start, because I could definitely go down that rabbit hole too. I find that very interesting.
Why don't we just do this for a couple hours and we'll just let everybody.
Oh yeah, no, I would be happy to, but my marketing team would kill me if I gave them a 3-hour podcast. So again, how do you make money at this? Because it's easy enough. People look at a loan that haven't done this before and they say, okay, yeah, you lent someone $100,000 for 6% interest, and then every month on an amortization table, just like my own personal mortgage, it's based off the running interest that's out there, and then eventually you pay it off. Well, that's all well and good. And if you can run a loan to fruition, awesome. You made good money on that. But if someone, pays off, especially with investors, even if it is planning to be a long-term hold, maybe their long-term is 5 years. 5 years out of a 30-year. Yeah, 5 years out of a 30-year note. That's better than some, but still not great. So, again, going from those three that we talked about, long-term, rehab, flip, what are some things that people can do to either bake into the note to help make sure that they are making money? And, we don't want to make this untenable for the people borrowing money, but what are some common things that can be looked at, put into each one of those three buckets that can help people, hedge people repaying these things, quote, too quickly for them?
Okay, well, two things. And I will tell you, I'm not a big fan of a prepayment penalty. Some of the new in vogue loans, like a DSCR, they have a prepayment penalty, but that's more or less so those loans can be sold in what they call securitized,
Yeah.
meaning with Wall Street. Wall Street gives us the money that we turn around and lend out. We'd run out of money pretty quick. I'm not a rich guy, so I have to get my money from Wall Street or other sources. The two things that I think I would cover. One of them is the fee structure that you set it up with points. People, why do I have to have points? Well, points actually make it a little easier for a lender to I guess weather a quick payoff. For instance, let's say that you're borrowing $100,000 and there's 2 points on the deal, meaning 1 point equals 1% of the amount you're borrowing. So a point on $100,000 is $1,000. So let's say you do two of them or 2,000. So I sign a loan with you for $100,000, but I only give you 98,000. I'm keeping the two. I've fully earned those points as soon as I sign the loan. And then let's say that I'm charging you 10% interest. I'm just 12% interest. It's a little easier in 12 months. So in other words, $1,000 a month in interest on that. And you only pay for 3 months and pay me back and pay me off. Well, I've made the $3,000 in interest, those $1,000 interest payments, but I've also made the $2,000 when you first signed it. So over a 3 month period of time, and I'd have to get my slide rule and my calculator out, but I've earned 5% or 5,000 on my money in that 3 month period of time. And if you do the annualized yield on that, that's a heck of a lot higher than 10% interest rate or 12% interest rate that we did. So I think having some points up front doesn't have to be too many, but enough to be able to compress that yield.
Yeah.
Secondly, I think a big thing that people tend to do, and banks understand this. People don't understand why banks only lend out for maybe 5 years. Well, the reason they do that is because they're very sensitive to interest rate risk. Well, let's set the Wayback Machine a couple of years ago when rates were 4%. And let's say you're an IRA lender. I'm going to make a lot of money and I'm going to charge 6, way above what the rates are. Well, that's a pretty good deal right now. Do you think anybody is ever going to pay you off at 6% right now? Probably not, unless they have to sell the property. They're going to hold that. They're not going to be able to refinance it at all. So you have to be very sensitive to that, because now you're an investor getting a 6% yield when you could be getting 8 or 10. So you have to kind of control, and how you do that sometimes by adding a balloon to the deal, maybe a 5-year balloon, saying we'll figure the payments over a 30-year. We'll do interest only payments, but we're going to have that thing come due and you have to pay it off in, say, 60 months.
Yeah.
That's
And another nice thing about doing stuff like this, granted, it's, I think fallen out of vogue after the 07, 08, but if you're doing investor stuff, you can do adjustable rates on those. You don't necessarily have to be into it fixed. I would say most people, and especially investors, they like a good deal, but they also, a lot of people learn their lessons back then if they've been doing it long enough. And, being able to run your numbers and know what your fixed costs are going to be is nice, especially when you see something like's happening now or any type of market fluctuation. If you have to hold that, you want your carrying cost for that to be very well, just in case it keeps going down and you don't have to take a bath on it. Like, you want that to be fixed. But again, that's something else that I've seen as adjustable rates. Balloon payments are definitely something we've seen. Points on the loan, for people that, again, to wrap your mind around that, that's, basically the cost for them to access your money. If they want private money and they're coming to you and you're doing it, that's, kind of their cost up front to access it, if you will. So, would you say that would cover, again, the first two? What about for flippers? Would there be something different baked into that, or would you maybe just require more points up front because you know that the money, their goal is to get you your money back as fast as possible?
Correct. So points are key on that. We typically don't have a term, definitely not over 18 months, but the term is usually 12 months for a flipper. If they're still in a deal after 12 months, something's wrong.
Yeah.
Now, if you're doing a ground up construction deal, you have to look at that a little harder. Now, we don't fund most of those until they've already got their permits, their plans, their permits approved, they're ready to break ground. Then at that point, we go in and we fund that loan, and that's when the interest starts ticking. Savvy investors that have gotten to the point where they're ready to build a house are not gonna. They know what the time value of money is.
Yeah,
they
absolutely.
Know the carrying cost, absolutely. So.
Now, when it comes to points, do you have to be cognizant of violating any usury laws? Do you have to calculate the value in that to the total compounded interest, or is that separate?
Well, there's a reason that we don't do loans. when I'm selling a loan off to an institutional investor, most of them won't do a loan under $100,000. There's two reasons for that. Number one is what you're talking about, the amount that they can charge. A lot of them are as of a percentage. But if you think about it, I've got a salary to pay. The transaction manager gets a fixed amount for his salary. There's a lot of fixed costs that go in along with doing a loan. So if you're doing a loan for $10,000 versus $500,000, but your transaction manager costs you $500 to do the transaction, regardless of the size, that really skews what you have to make to cover your nut. So, but yeah, and every state is going to be different as far as usury is concerned. So I would certainly look into that with your Department of Banking and Finance, of what the usury, what you can charge, what you can't charge. There are some federal rules, but for the most part, that's going to be pretty heavily state driven.
Yeah, and those in the again, just like with real estate, and anyone that's done a rental agreement knows just how annoying it can be to deal with, like local, state, federal regulations with regards to tenants' rights. There's also that kind of stuff you have to deal with regard to to loans. I mean, you have some federal usury issues. You also have state. I know the usurious rate in Georgia is different from Florida, and it also differs whether it is a more of a consumer loan, an unsecured loan to an individual, or if it's secured by some type of collateral, whether that is something that is like commercial equipment, like a UCC type collateral, or if it's single family residential real estate or commercial real estate. There's a lot of stuff that kind of goes into that, in factoring in, how much money you can charge on these kind of things. Now,
well, I think it's how much you can also sell to your customer.
Yeah.
Because let's go back to that thing I was talking about earlier, the BATNA, the alternative. What's your alternative? If I'm a borrower, I'm going to flip a house and I come to you and you're lending money, you say, you know what, Doug, I'm going to charge you 18% on this deal. Like, well, that's crazy. I can go to this guy over here and get 12. Why would I do that? So you have to be cognizant that you've got to be at least somewhat competitive in your market.
Yeah.
Not too competitive, but you want to be in there to be able to get the deals. But if you're charging something way beyond, supply and demand, you're not going to get very many.
Yeah, and I would say that the statement I said right there is more aimed towards people that really want to take on the riskier side of things. Someone that's been flipping houses for 30 years and has a great track record, they know enough people. They're not gonna, if you want to charge them 18%, like, this guy will do it for 10 all day and he's been dealing with me for 15 years. It's, if you want to take on that slightly riskier borrower profile, risk comes reward in anything you do when investing. So that's just kind of, again, for the most part, if you're dealing with the single family commercial stuff, people just aren't going to pay something that's double market rate.
No.
There's a reason that they can't get it from anywhere else, and dealing with those people, that's kind of just on the the other end of that bell curve of things you might need to be aware of. But the reason I also like to bring that up is something I've also seen in lending, especially with real estate investors, as money has gotten more expensive. And I don't know if this is something you can speak to or not, or maybe even just give some thoughts on it, are things that are kind of interest alternatives. So baking into a note on a project, something that we like to call equity participation. So in lieu of maybe an interest rate that's market rate, say, hey, we're charging you 0.5% interest on this loan, but the due consideration for receiving the money is 15% of the profits over and above the basis in the property at sale. And I've had some people that have argued, well, that could be considered violation of usury if the underlying basis was $100,000 and they make 100,000 of profit and you get 50 back or 25 back. Well, that's 25% interest on the loan consideration. So any thoughts on that? Have you run across any of that stuff, or any of the more creative side of single family lending?
Well, I've seen a lot of creative things. It's not something I've ever done. That sounds a lot more like what they call a mezzanine setup, to where you're taking part ownership, it's part debt, part equity, meaning I'm lending part of it, but I'm also keeping back a certain percentage of the deal. So that's called mezzanine finance. I'm not an expert in that, to be honest. And I'd really, if I'm going to be an expert on your podcast, I want to make sure that I'm talking from
For sure. Yeah.
yeah,
Absolutely.
so as far as that question is concerned, I'm probably not the best person to do. That sounds more like, we call it a mezzanine or a mezz deal. I'm not an expert in that, but I do see a lot of people getting somewhat creative in how they do business. I, I've went off on this whole new subject to thing that they have out there. A lot of people are getting this subject too, and there's some gray areas in that. I'm just going to shut my mouth on it because I know that a lot of people don't agree with me from a legality standpoint on it. But there's some creative seller finance type of things that people can do. But if you're lending your money, here's the thing, and I want to go back to something you mentioned because it was in my
Sure.
head. I didn't bring it up.
Go for it.
When you're talking about, I want to charge a lot higher than the market, and somebody comes to you and says, I'll take it, but somebody like me's not giving it to them, you have to ask yourself why.
No, yeah.
Why are professional lenders balking at giving this person the money? And then they come to you and, gosh, this is a really good guy. I'm going to give you an example from when I was a baby lender. I was fresh out of college, and I could have been on the job more in a couple of weeks. And this guy walked in. He was a minister, local pastor. Um, he was just a pillar of the community. He sat down in front of me, and of course, we had the old CRT screens. I'm dating myself now with the green print, but you could put you push a function key, and it would pull their credit report. We were way ahead of the game back in '91, I guess it was. And he never paid a debt he'd ever had in his life. And I was confused by that because he was a clergyman. So I walked to the back of the room and knocked on my boss's door, and the regional manager was there auditing the branch at that point. I said, can you look at this deal? And they said, well, what's the problem? Just decline him. He hasn't paid any of his bills he's ever had in his life. I said, but he's a minister. And they laughed at me. They said, decline the guy, come back, and we'll tell you the real deal. So I declined him, and all the God bless yous turned into something else yous. Out the door. He changed demeanor pretty quick. But what they taught me was something very interesting. The bank had done a study on the best paying and the worst paying profiles. So when I take an application from you, I'm going to put what your job code might be: nurse, police officer, whatever. Well, the best paying profile is a registered nurse. Believe it or not, they statistically pay their bills better than anybody else. But the worst, and it's not even close, is clergy. And I know that sounds weird, but statistically that's true. So one of the things that you can't really get stuck on is how good the person appears to you. You can't say, gee, I'm going to give him the money because that's a good guy. I'll tell you, I've seen that burn so many private lenders in the past where they fall into facades and they don't realize that, listen, you got to dig a little deeper under the onion, because sometimes the person that's standing in front of you, the facade, the face, the mask that they're wearing, is not who they really are and how they're going to pay their bill. So I'm sorry for going off on a little bit of a tangent there, but you have to ask yourself, why would somebody come to you if you're charging 20% on a deal when the market rate is 12 and professionals like me are turning them down?
Well, absolutely. And it's, just because, you had, and again, I always encourage people, look past the surface of them, but it also brings up things like, don't get distracted by what's shiny and in front of you. If you're talking to a guy that's going out and, has said that they're extremely successful, let's say, flipping mobile homes that they park out at oil fields, next to oil derricks and everything. And the guy comes in wearing, a suit with polished shoes and a Rolex watch. I'd be like, really? You're working out in an oil field? Like, why isn't anyone else giving you money? It's just because they may look the part of someone that you want to give money to. Again, doing your due diligence, doing your homework, and understanding that, the guy that walks in that same scenario that's wearing, Carhartts with holes in them and a pair of work boots that says the same thing, just understand that there's, judging someone simply by the way they walk in, doing your homework, understanding what might be, reasonable for what the people are doing, and that there is numbers behind this stuff is a good idea. And again, that's understanding whom you're lending to, not just the underlying collateral. House could look great, but they can take your money and never do a single thing to it, and then you're out all your money. And hey,
can you verify their character? Can you verify the capacity to pay you back, whether it's income, whether it's assets? And can you verify the exit strategy? Not only a primary payback, we're talking collateral now, primary, secondary, tertiary ways to pay you back. If for some reason you lose your job, or this deal goes south, how am I going to get paid back? And you have to really look into all of those areas in order to make a really sound credit decision.
Absolutely. And one of the last things I want to kind of get into with you is term of these loans. Again, I'm assuming that they scale from the beginning of what we talked about to the end of how long these things typically lay out for. And it's, again, probably a good balancing act of saying, hey, you know what? I want to make sure that I get my money coming back in and either stick a balloon in there, have it be a 5-year term, or saying, hey, this could be a long-term one, let's do it 15 at slightly lower interest. There's really good security. There's good people on it. Is there a general kind of thought on, what you like to do or what you see people doing most often in each one of those three categories? Or again, does it boil down to looking at the deal individually for each one? I should say it's probably the first two, because the last one you already answered. You said if they're doing it for longer than 12 months, something's wrong.
Well, that's on a flip.
Yeah, the flip. Mm-hmm.
If you're going to hold it, the in vogue DSCR type of loan that everybody talks about now, those are actually being funded by Wall Street by long-term money. Those people are wanting to hold it for super long term. So those aren't going to have balloons on it. The longer the term it goes, the more likely I am to sell that loan in the secondary market. If it's going to be a short-term loan, then I'm probably going to hold it, for 12 months or whatever. So I think you have to ask yourself what that yield is going to look like, what the return on investment, the cash on cash is going to be for, in this case, your IRA. Do you really want to get, well, and here again, let's set the Wayback Machine 2 or 3 years when the rates were 3%. You'd go in and do a 5% loan in your IRA, and now you can go to the bank and get 5.5% with some banks right now in a money market or a CD. So do you really want to be locked into a lower interest rate? I think someone that tries to lock in too long, particularly in a long-term vehicle like an IRA, it sounds sexy. Oh, I've got plenty of time before I retire. I might be 40 years old or 30 years old. But you have to think that the market is going to change during that time, and you have opportunity cost to think about. I might be able to wait. If I would have made that loan 3 years ago at 3 or 4%, I might be able to wait and get 9 in a couple of years. So I think you have to be a little bit more flexible. But to answer your question, the shortest term is going to be a flip. We call it a bridge loan. It's not. We don't like the term hard money, by the way. Hard money is a dirty word. We like bridge or flip loan. Those are going to be 12, maybe 18 months, depending upon the project. Ground up construction is typically 12 to 24 months max, usually around 18. And then your rehabs for holds, they don't really exist. You usually do a bridge loan and then convert it into a longer term, like a DSCR type of thing, unless you're doing private lending, like you might be out of your. I should say there's no institutional market for that right now.
Yeah,
there is, maybe a community bank might do it, or somebody might structure that out of their IRA. But here again, how much money do you have in the IRA to be able to lend out? Number one, I chatted with somebody yesterday that they had 30 grand in their IRA, and they said, I want to put it in one loan. That's black 8 on a roulette wheel, man. Do you want to spread out your investment? So if you take a hit in one, there's a lot of factors to think about when you're lending out of your IRA.
Oh, for sure. And I always encourage people, especially, and it's one of the reasons why I started this podcast. We're closing on our 80th or 90th episode now, is to bring that additional education on. That's a great example you use of saying, hey, yeah, there's a lot of people out there with $30,000 in a retirement plan that want to do something besides just, again, picking black 8 in the stock market, but you can still pick a number on a roulette wheel doing alternatives. Just because something might inherently have an asset you can reach out and touch, you can still be just as risky, if not more risky, doing this than you can in Wall Street. It's all about education, understanding what you're doing, understanding who you are investing with, and what the underlying basis of that investment is, whether that is, real estate that's securing collateral, whether that's the person individually on an unsecured loan, whether that's any number of things, is understanding all that so you mitigate and reduce your risk. You're never going to eliminate it, but making sure that you don't trip over the easy things like we talked about today, like understanding that owner-occupied stuff has, easily 900 pages of regulatory things that need to be gone through by an expert like yourself, Doug, or, if you're doing something that goes into the spectrum of saying, hey, lending someone a note for 15 years on a flip, not a great idea. Just, things that are easy to identify and reduce your risk and understand what you're doing, you're going to have a better experience. So with that said, Doug, I'll let you kind of give any final thoughts that you have, and then we'll bring this in for a landing.
My job is 100% mitigating the downside risk to an investment. Trying to figure out how in the world are we going to get burned on this deal, and how do I keep myself or our company or the investors that we're representing, how do we keep them out of trouble? How do we're not just looking at something that's, oh, it's shiny, it's sexy, I love this property, it's right across the street from the beach. It's all a math problem, and you have to look at it without emotion, with experience. I'm learning new things every day, still 32 years later. And so how could somebody that's brand new at it know everything within a short period of time? You just can't.
Yeah.
So my entire job is mitigating downside risk, and that's really what any lender wants to do out of a portfolio.
Awesome. Well, again, I really do appreciate you being on with us today. It's fantastic to have people with a lot of experience come onto our podcast and share some of their wealth of knowledge, because there's been such an awesome market for the past 13 years that people, especially in today's market, there's people who have built an entire career in a market that really hasn't had a huge issue. Granted, we've had increasing interest rates, but the underlying security of those things is still selling at a high velocity. So money's getting more expensive, but people are still consuming it. So, to have someone,
we're taking it out as fast as we can take it.
Yeah,
we have
exactly
deals coming at us as we can fund right now. And just because you think the market is slow, there's still a lot of opportunity out there. So don't think there's not.
Absolutely. And Doug, if people want to get in touch with you, if they're interested in learning more about doing it, if they need help originating a loan or, putting their money to work, how can they get in touch with you and Castle Rock Capital?
Well, our website is pretty simple. It's mortgagesbycastlerock.com. That's mortgagesbycastlerock.com. Or you can call me directly, 813-727-3621. That's Tampa, 813-727-3621. And that is my cell phone. Believe it or not, it's right here. And God knows it's went off enough during this podcast. Thank God it's on silent.
Absolutely.
I have a lot of calls to return.
Fantastic. Well, it's better than the alternative not being busy, especially when you're in business. You want that phone to be ringing. Just maybe taper off around 6. It's when it starts ringing at 3 a.m. that's an issue.
Oh my God! I had a conversation with their transaction manager today. We have a loan officer that likes to call her at 10 o'clock at night on Sunday, and he doesn't really get the time space thing. that there is a clock on the wall. So
absolutely. All right, again, Doug.
Thank you so much. I really enjoyed it. Thank you.
Fantastic. Well, thank you so much for being on with us today. My name is Alex Perny. This was Doug Smith, and again, thank you very much for joining the Alternative Investing Advantage podcast. Have a great day.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.